Buying a house is a really big deal. It's super exciting, but it can also be a little nerve-wracking. One of the biggest choices you'll make is what kind of mortgage to apply for. Today we're talking about two kinds: readvanceable mortgages and conventional mortgages. We'll explain each one so you can figure out which one you think might be best for you. Let's start with readvanceable mortgages. These unique financial products can be a game changer for homeowners looking for flexibility and convenience. They can be accessed through most of the banks and some credit unions. However, these mortgage products can be a little confusing at first. The idea of borrowing against your home at any moment might seem daunting, and understanding the terms and conditions is crucial. But what exactly are they, and how do they work? These are kind of like two things in one: a fixed-term mortgage and a revolving line of credit. Imagine having the stability of a traditional mortgage combined with the flexibility of a credit line. This means you can manage your finances more dynamically. You pay down your mortgage like you would do with a traditional mortgage payment. Each payment reduces your principal, just like with any other mortgage. But there's more to it than that. With a readvanceable mortgage, you can borrow the principal portion back each month if you need it. As you pay down your mortgage, the amount of the principal you've paid off becomes available for you through a home equity line of credit, or HELOC for short, each month to borrow again. This can be incredibly useful in various situations, such as investments. The HELOC portion is like a revolving door. Money can flow in and out, giving you access to funds when you need them, without having to apply for a new loan each time. This can be done through a simple transfer on your banking app, or by visiting your bank. The HELOC allows you to tap into some of the new equity you've built up in your home automatically each month, providing a safety net for unexpected expenses or even investment opportunities. Readvanceable mortgages have some great features. First, they're flexible. Need money to fix up your house? Have large, unexpected bills come up? No problem. You can tap into some of the new or existing equity. You can use a readvanceable mortgage to combine debts. Want to purchase that rental property? That money can be used to help contribute towards the down payment. Let's say you have high-interest credit card debt. You can pay it off with your HELOC, which usually has a lower interest rate. In Canada, readvanceable mortgages can help you save on taxes. If you use the borrowed money for investments, you might be able to deduct the interest from your taxes. Consult a licensed tax professional for more information. Readvanceable mortgages have great features, but there are also some risks. Although these types of mortgages can offer flexibility and access to funds when you need them, they come with their own set of risks that you need to be aware of before diving in. Understanding these risks can help you make a more informed decision about whether a readvanceable mortgage is right for you. One risk is the variable interest rate that often comes with the home equity line of credit, or HELOC, portion of the mortgage. Unlike a fixed-rate mortgage, where your interest rate remains constant throughout the term, a variable rate can fluctuate based on market conditions. This means that while you might start with a low interest rate, it could increase over time. Because of this, it can also be more difficult to qualify for a readvanceable mortgage, since there may be stricter qualification rules, such as needing more than 20% of the purchase price. Many lenders require a minimum of $10,000 available in built-up equity in order for the readvanceable feature to work. If the market interest rates rise, your monthly payments on your HELOC could increase significantly as well, potentially putting a strain on your finances. Conversely, if rates drop, you could benefit from lower payments. Another risk is the potential to borrow too much. Although most lenders don't allow borrowers to over-leverage themselves, the ease of access to funds through a HELOC can be tempting, leading some people to borrow more than they can comfortably repay. This can quickly spiral into a cycle of debt that can be hard to escape. Lastly, readvanceable mortgages can be harder to manage than conventional mortgages. Keeping track of both your mortgage payments and your HELOC balance requires careful financial planning and discipline. Without proper management, you could find yourself overwhelmed by the complexity of your financial obligations. This means regularly reviewing your statements, monitoring your spending, and ensuring that you are not borrowing more than you can afford to repay. Using financial tracking tools and apps can help you stay organized and on top of your finances. Understanding conventional mortgages. Now, let's talk about conventional mortgages. These are the most common type of mortgage. They're simple loans you get from a bank or credit union. With a conventional mortgage, you make regular payments for a set amount of time, usually 15 or 30 years. You can pick a fixed-rate mortgage where your interest stays the same, or an adjustable-rate mortgage where your interest rate can change. Conventional mortgages are popular with home buyers. They're stable and predictable, but they also have things you need to think about. Benefits of conventional mortgages. Conventional mortgages have some good things about them. First, they can be easier to qualify compared to readvanceable mortgages. Since conventional mortgages don't have the readvanceable feature, it helps to reduce the risk of the borrower accessing more equity each month. Second, conventional mortgages give you lots of choices. You can choose different loan lengths and payment plans to find what works best for your budget. Third, conventional mortgages can be good if you have good credit and a solid financial history. A good credit score and low debt can help you get a lower interest rate. Risks of conventional mortgages. Conventional mortgages have good points but also risks. While they are a popular choice for many homebuyers due to their potential for lower interest rates, it's important to be aware of the potential downsides. Understanding these risks can help you make a more informed decision when considering a conventional mortgage. One risk is the need for additional equity access. Unlike readvanceable mortgages, once a borrower signs off on the conventional mortgage, the principal portion of the monthly mortgage payment is not accessible until the mortgage term matures. There is the possibility of having a HELOC, but in this case that's a separate loan product from the conventional mortgage. Unlike the readvanceable mortgage, the limit doesn't increase automatically each month. If the borrower wants access to more equity during the conventional mortgage term, they will need to go through another application each time. Like a readvanceable mortgage, you usually need at least 20% down. This means if you're looking at a $300,000 home, you would need to come up with $60,000 just for the down payment. This can be a significant hurdle, especially for first-time homebuyers or those without substantial savings. If you don't have at least 20% of the purchase price, you'll need private mortgage insurance or PMI, which adds to your monthly costs. PMI is an additional expense that can make your mortgage payments higher and more difficult to manage. It's important to factor in this cost when budgeting for your new home. In terms of qualifications for both mortgage products, if your credit score is low or you have a lot of debt, you might not qualify for either of these. High levels of debt can also impact your debt-to-income ratio, which is a key factor lenders consider when approving a mortgage. It's crucial to manage your debt and improve your credit score before applying for either a conventional mortgage or a readvanceable mortgage. In conclusion, while conventional mortgages and readvanceable mortgages offer many benefits, they both also come with risks. It's important to weigh these risks carefully and consider your financial situation before deciding on which mortgage product to apply for. By understanding the potential pitfalls, you can make a more informed decision and choose the best mortgage option for your needs. Which mortgage is right for you? Choosing between a readvanceable and a conventional mortgage depends on you and your money goals. If you like flexibility and easy access to credit, a readvanceable mortgage might be good. If you like stability and knowing what to expect, a conventional mortgage might be better. Think about your finances, how much risk you're comfortable with, and your long-term goals. It's important to weigh the pros and cons of each type. There's no single right answer when it comes to mortgages. Get personalized advice. Mortgages can be confusing. That's why it's important to talk to a mortgage expert. They can help you understand your options, look at your finances, and find the best mortgage for you. Don't be afraid to ask questions about anything you don't understand. This is a big money decision, so make an informed choice. If you liked this video, give us a thumbs up and subscribe for more money tips. Thanks for watching.